All right, ladies and gentlemen, I hope you had a wonderful holiday weekend. We got a full week ahead of us with the start of earnings season, and then we also get the CPI. So before we get into any of that, we got to talk a little bit about what happened on Friday because it kind of relates to the big question. So one, if you missed out on Friday, I was not live, but the non-farms came in. They were stronger than expected, but there was some revisions for the last 2 months that got people excited, but nothing was able to stop the market. You hit new all-time highs, and a lot of things rallied. Now, maybe it might be weird to ask this question, hitting all-time highs, but we have gotten this a lot on stream, and that question is, when is the economy going to crash? So why I'm bringing it up now to start off, I thought we'd do this Monday a little different, but you also just saw this on Friday. It was job revisions, and a lot of people were paying attention to that. So this is what I would tell you right here, right now. When you see the job revisions go negative, I think it's been years, since 2020, since you have seen non-farms come in negative. Once you start to see a negative non-farms, whether it is a active print or it is a revision, that will be one sign that the job market has finally given into some of the pressure. The other factor you got to watch out for, it will be the yield curve. We made a video the other day when the yield curve, or when's the best time exactly when to buy TLT. I would watch that video, but it's quite simple. Until that yield curve normalizes and uninverts and you see the Fed going from this attitude of, okay, we got to be cautious on the timing of rate cuts because of inflation and all that, and then they start saying, no, we got to cut rates, and they start going rapidly, that will probably be a sign that the economy is slowing down. The consumer and those job revisions are actually coming into play. So those are some two broader factors. That's one way to answer the whole thing. But if you also want to look at something for the short term, it applies a lot to this watch list and what we're going to talk about. And this week, you got the beginning of earnings, and I would watch out for earnings to mark any sort of shift. Bubbles in the past, they have popped when there has been earnings surprises. So we are about to get into that here in these next couple of weeks. We've been witnessing some consumer slowdowns, and people are asking about inflation and all of that. If there are going to be trends that really get confirmed, that will be a result with earnings, or at the very least, on the other side of the coin, if some of these earnings come in good, then people are going to go punt on that idea of things are actually slowing down. So I hope this is a great question. You let me know what you think. I hope it gives you some patience. And in the meantime, we're probably going to do a lot. And now this week, we got a lot to deal with. So Chad, I have a lot more for you. I have the keys, the calendar, the plays, everything we're looking at. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/The Stock Market. We will see you there in the morning, and do not forget about the random account generator. I actually do forget every now and then. But this is the random account generator, and today is Sunday. Tomorrow is Monday. What we ask on this watch list, you post a random option trade. Keep it below $100. No spreads. None of that stuff. Just pure option play. Keep it below $100, preferably with time. And then tomorrow, we are going to do a random comment generator before the bell, and we are going to select one of these names. So, Chad, thank you for your help, and we need it. So, yalla, run it, baby.
Working to the couch, it's the 2020 election. Live in the hills, but still get a spread. Started with a live, but still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, we already covered some of the broad factors, and I already told you here about earnings, but earnings and inflation, those are going to be the main themes of the week. You're going to be starting off with the banks. I believe Wells Fargo, JP Morgan, and Citi, and I think is going to lead right into Netflix next week, and then Tesla, or do we already know? We already got Tesla delivery numbers, so you're going to get a lot of that there starting off. I'm sure you're going to hear a lot on the company level, and then at the end of the week on Thursday, we will be getting the CPI, and now, even after the reaction last week and all of these trends people are looking for, that data will be key. Remember, the next Fed meeting is going to be in the heart of earnings at the end of the month, and then we skip August, and then you're going to get that SCP there, I believe around September. So it's going to be a nice little setup here, but I would pay attention to the data. data. And then speaking of the Fed, you also have a ton of Fed speakers this week, mainly with Powell before the House Financials Committee and then the Senate Banking Committee. And both of those are going to grill him on their semi-annual conversations with Powell. I even think we're going to hear from Yellen. So we'll see. Usually in the mornings you get like a couple of headlines, but it's not like you actually get a bunch of craziness out of these events. But pay attention to those Fed speakers. Watch out for the Fed. And then other than that, earnings and CPI should dominate. So watch out for that. That is key number one. Then coming into key number two, there is still going to be a lot more to digest outside of the United States. We are going to have a lot of news here domestically, again, earnings and data, but you are going to be getting a bunch of other foreign CPIs and PPIs, and then even into tonight on Sunday, we should be waking up hearing news from that French election. We saw a little bit of that on like Wednesday or Thursday or Wednesday, I believe, leading into the end of the week, and you saw gold and some other things like bonds move, so watch out for that. We have been keeping an eye out for it, and with our elections coming up, maybe whatever happens overseas could be giving you some clues into what we may be dealing with, so watch out for that. That is key number two. And then finally, don't forget the main drivers. It's going to be earnings here with things to confirm or deny some of these trends, but that low liquidity summer, you're even watching bonds drop and pop, and you're seeing how easily we could do nothing for a couple of weeks, and then one set of moves, you're breaking out, hitting a new high again. Doesn't matter how anybody feels. It's not like things are going to really change too much as we are riding that path. So if you are going to see anything, like I'm saying, watch out for that earnings, and earnings season will now officially begin to get underway at the end of the week. You'll hear a couple of other companies. The banks are going to come in on Friday, and then that's going to lead into the Netflixes and everything next week. You're going to already get the data, and then you'll get like 1 week, and then it is Powell and the Fed time. So I hope you're ready. But now let us get into the plays. So right off the bat, it shouldn't be a surpriser. We've already talked about a couple of these, but banks. So JP Morgan, Wells Fargo, Citi, those are going to be reporting. I believe Citi has the most value. We've talked about this a couple of times. I even think like Bank of America or Wells Fargo, they're even trading below some of those 2020 levels. So keep your eye out for them. I think banks are going to be weird though. And I said this, we were going over some plays and we were looking at it last week, but I think the only good play is going to be downside surprises. If you look at all the banks, they're kind of all moving the same. They've been riding up despite whatever bonds have been doing and people are expecting from policy. There's like two ways to look at it. Do they benefit or hurt off of rate hikes or rate cuts? It's kind of weird there, but all of the banks are trending up. If there's going to be any big moves on the earnings, I don't know if any banks are going to really surprise to the upside this quarter, but if you are going to get big option moves, I think it's going to be on the downside on any of these bank plays that have all just been melting up here. So that's my opinion. We'll see how it plays out. Watch out for that. That is play number one. Then play number two. This one's kind of easy, and after Friday, last couple of days, it started to make moves. I already talked about it here with some of the election stuff, but we have more data around the corner. You're even going to be hearing from those central banks if ours is at the end of the week. Remember, it just is one thing about the U.S., but other central banks can affect gold. It kind of slowed down, but after that move on Friday, it kind of looks like the market. It's near 2,400. It's only been above there a couple times, so if that starts to break out here with the data and earnings, I would definitely watch out for that. I'm still in some of those micro gold futures that we have been riding out, so going to see how that plays, but that is play number two. Keep an eye on gold. Don't have a silver play yet, but it's always on the menu. I just want it to underperform though, but watch out for that. That's number two. And then finally, play number three. There's even another name I could add on this, but I'm going to start with Meta here. They broke out there. I think they hit a new high on Friday, but this one could be exciting this quarter. They're already near the all-time highs. They didn't move much on the last earnings. They are one of these names that have just been leading for the last like year or two in terms of like big percentage. Again, I think they're up like 400% or something, but I think Meta has the potential to come in with a big surprise or a big miss. They're related to both AI and the consumer, the ad market and all of that, and now with them being at this level, I do think the bar is high for any AI stuff and all of that, but I think Meta might have a bigger move. And then after that move on Friday, I mean, it moved $29. That's kind of already giving you somewhat of a pre-earnings move, so be careful, but going to be watching out for for that. But that is play number 3. As far as what I did on Friday, again, I was not there on stream. I just held my gold and my bonds. Gold buy, it's good. It stops the itching, I think. No, but gold, we have those MGCs. I had that bond play. I was only trying to make a flip on, then I got clapped on it, then that came back up. So I'm going to be looking to get out of that this week probably. Other than that, going to see what these earnings plays bring. If we get any good pricing in on them and it makes sense with the direction and some of the trends, or like we already learned from Nike, if that writing is on the wall, I would definitely follow it. But besides that, I don't think there's anything else. Yeah, I had the questions, and now let's get into the East Asian model. Remember, we were doing, I believe, neoliberalism in the ISI Part 2. So we're seeing where things have changed and why they've got to where they've got. And why I say I get excited about the East Asian model, there's a lot that it's going to be relatable to both what's going on right now with Japan, but even in the past and how things have developed, this East Asian model and the tech influence of Japan and China and all these other countries, and even some of the failures of currency and trade. There's a lot that gets packed into here. Again, Asia from like the 70s all the way to the early 2000s, even to today, they're very, very fascinating. So I'm very excited to get into it. So remember, anytime I interrupt, that will be my opinion. This is Thomas Oatley, International Political Economy, and do not forget, we have a playlist. I actually need to update it of all of these economic lessons. I've been throwing them in here to the watch list. So if you have been missing them, I want to make sure that you can be up to date, because we are almost like 200 pages into this textbook. So let us get into the lesson now. The East Asian model. Whereas ISI was generating imbalances in Latin America and Sub-Saharan Africa, 4 East Asian economies, Hong Kong, Singapore, South Korea, and Taiwan, were realizing dramatic gains on the basis of a very different development strategy. The dramatic performance gap is evident in 3 economic indicators. See Table 7.1. We'll get to that in a second. Per capita income in East Asia grew almost 3 times faster than in Latin America and South Asia, and more than 26 times higher than in Sub-Saharan Africa. Manufacturing output grew by 10.3% per year between 1965 and 1990. No other developing country came close to this growth for a period as a whole. Exports from East Asia grew by 8.5% between 1965 and 1990, while exports from Latin America shrank by 1.1% per year, or 1% per year. So here's the whole chart, and you can kind of see how they all grew in comparison. Whole point it's making is that while one part of the world was doing one strategy, Asia was doing something else, and they were getting massive tendies or gains, I guess, as the kids would say. Continuing, as a consequence, manufacturing grew in importance in East Asia, while the importance of agriculture diminished. This differed substantially from ISI countries, whereas agriculture importance fell, but manufacturing failed to grow. The growing manufacturing sector transformed the composition of East Asia exports. By the mid-1990s, manufactured goods accounted for more than 80% of East Asian exports. By contrast, only in Brazil, Mexico, India, and Pakistan did manufactured goods account for more than 50% of total exports by the 1990s, and most of these gains were realized after 1980. Finally, per capita incomes in East Asia soared above those in developing countries. In 1960, per capita income in East Asia were lower than per capita in Latin America. By 1990, East Asian economies were higher, and in some cases, twice as large as per capita incomes in Latin America. Why did East Asian countries outperform other developing countries by such a large margin? Most people who study East Asia development agree that the countries in the region distinguish themselves from other developing countries by pursuing export-oriented development. In an export-oriented strategy, emphasis is placed on producing manufactured goods that can be sold in international markets. Scholars disagree about the relative importance of the market and the state in creating export-oriented industries. One position, the neoliberal interpretation, is articulated most forcefully by the IMF and the World Bank. This thesis argues that the East Asia's success was a consequence of market-friendly development strategies. In contrast, the state-oriented interpretation, advanced by many specialists in East Asian political economy, argue that East Asia's success is due in a large part due to state-led industrial policies. So neoliberalism say that East Asia did good because they were favorable towards the market and they were feeding into what the market wanted and was doing. And then the East Asia, or the structural approach, in contrast, or state-oriented, is saying that it's because the states and the policy that the governments pursued to make this happen. So the IMF and World Bank contend that East Asia's success derived from the adoption of a neoliberalism approach approach to development. This interpretation places particular emphasis on the willingness of East Asian governments to embrace international markets and their ability to maintain stable macroeconomic environments. Most East Asian governments adopted ISI strategies in the immediate post-war period. Unlike governments in Latin America and Africa, however, East Asian governments shifted to export-oriented substitution once they had exhausted the gains from easy ISI. In Taiwan, for example, the government shifted in 1958 from production for the domestic market to a strategy that emphasized production for export markets. South Korea adopted similar reforms in the early 1960s. A second wave of newly industrializing countries, NICs, a group that includes Indonesia, Malaysia, and Thailand, followed the same path starting in the late 1960s. The emphasis on exports forced Asian manufacturing firms to worry about the international competitiveness. As a result, the World Bank and IMF argue that Asian societies invested their resources in domestic industries profitable in world markets. The shift to export-oriented strategies was followed by selective import liberalization. Asian governments did not engage in wholesale import liberalization. The Taiwanese and South Korean governments continued to rely heavily on tariffs and non-tariff barriers to protect domestic markets. In Taiwan, for example, approximately two-thirds of imports were subject to some form of tariff or non-tariff barrier greater than 30%. As of late 1980s, more than 40% of imports faced production greater than 30%. A similar pattern appeared in South Korea, where as of late 1983, most sectors were still protected by some combination of tariffs and non-tariff barriers. However, select liberalization helped promote exports by reducing the cost of critical inputs. Reducing tariffs on key intermediate goods such as looms and yarns in the textile industry enabled domestic producers to acquire inputs at world prices. This kept exports competitive in international markets. East Asian governments also maintained stable macroeconomic environments. Three elements of macroeconomic environment was particularly important. First, inflation was much lower in East Asia than in any other developing country. Between 1961 and 1991, inflation averaged only 7.5% in the East Asian economies. By contrast, annual inflation rates in the rest of the developing world averaged 62%. Second, because governments kept inflation under control, they could maintain appropriately valued exchange rates. In many developing countries, high inflation caused the domestic currency to rise in value against foreign currencies, making exporting difficult. In the East Asian countries, by contrast, governments were able to maintain exchange rates that allowed domestic firms to remain competitive in foreign markets. Third, East Asian governments pursued relatively conservative fiscal policies. They borrowed little, and when they did borrow, they tapped domestic savings rather than turning to international financial markets. This approach was a stark contrast to Latin American governments, which accumulated large public sector deficits financed with foreign capital. So again, they're highlighting the differences of why East Asia did so well, and they're saying these governments, they traded a lot differently, or they had different factors in developments. Lower inflation, they had governments that pursued conservative policies, and they also had stable exchange rates. So all of these things were giving them some of these considerable advantages that led to a completely different development. And that's why people, again, argue for this model or see how it's different. And they use this to justify a lot of stuff even we have today. Again, my opinion, but continuing. This stable macroeconomic environment had beneficial consequences for Asian economic performance. Low inflation promoted high savings rates and investment. Savings rates in Asian NICs averaged more than 20% of GDP, almost twice the level attained in other developing countries, whereas investment rates were 7% points of GDP higher on average than any other developing countries. The stable macroeconomic environment also made it easier to open the economy to international trade. Because inflation was low and exchange rates were maintained at appropriate levels, trade liberalization did not generate large current account deficits. Finally, the ability to maintain relatively stable and appropriately valued real exchange rates encouraged private actors to invest in export-oriented industries. The interaction between the export orientation, the relatively liberal import policy, and stable macroeconomic environment promoted economic development. As Donner and Hawes summarize the World Bank perspective, the pattern of limited government intervention in the market, coupled with cheap labor and an open economy, has guaranteed the private sector stability and predictability that the means to achieve competitiveness on a global scale and access to the international market so entrepreneurs can actually discover areas where they have comparative advantage. In shorthand, the model is often reduced to getting the prices right and letting the market-based prices determine resource allocation. Doing so results in export growth that in turn positively correlates with broader economic growth. According to the World Bank and the IMF, East Asia succeeded because markets played a large role and states played a small role in allocating resources. Other scholars have argued that that East Asia's success had less to do with allowing markets to work as much to do with well-designed government industrial policies. In what has been called the East Asian model of development, economic development is conceptualized as a series of distinct stages. Government's intervention in each stage identifies and promotes specific industries likely to be profitable in the face of international competition. In the first stage, industrial policy promotes labor-intensive light industries such as textiles and other consumer durables. In the second stage, industrial policy emphasizes heavy industries such as steel, shipbuilding, petrochemicals, synthetic fibers. In the third stage, governments target skill and research development, R&D, intensive consumer durables, and industrial machinery, such as machine tools, semiconductors, computers, telecom equipment, robotics, and biotech. Governments design policies and organizations to promote the transition from one stage to the other. So hopefully you're seeing the difference. Some people are saying, yeah, well, how the market developed in East Asia, they're saying, no, it wasn't because it favored the market and had these things. They're saying this was all planned by the government, and the government moved in stages, and eventually pretty much all governments plan to get to that last stage where, they're making everything like semiconductors, biotech, high-tech industries, which again, that's what leads to those higher incomes as discussed in some of the other chapters here. So continuing, these three stages of industrialization are evident in the path traced by Taiwan and South Korea. In Taiwan, industrialization focused intentionally or initially on light manufacturing, textiles in particular. By the mid-1950s, textiles were Taiwan's most important export. The government also encouraged production of simple consumer durable goods such as television sets. In the late 1950s, the Taiwanese government began to emphasize heavy industries. A joint venture between several Taiwan firms and American firms was formed in 1954 to produce synthetic fibers. In 1957, a plant to produce polyvinyl chloride was constructed under the government's supervision and then was handed to a private entrepreneur, Y.C. Wang. The government created state-owned enterprises in the steel, shipbuilding, and petrochemicals industry during the 1970s. Attention shifted to skill-intensive industries with particular emphasis on machine tools, semiconductors, computers, telecom, robotics, and biotech. By the mid-1980s, electrical and electronic goods had replaced textiles as Taiwan's largest export. The South Korean government adopted similar policies. In the late 1950s, the government emphasized textile production, and textiles became South Korea's first import manufacturing export. During the late 1960s, South Korean state-initiated development of chemical and heavy machinery industries. It created the Pohang Iron and Steel Company, known as POSCO, which subsequently became one of the world's leading steel producers. The government also provided extensive support to Hyundai Heavy Industry, a shipbuilder, became a world leader in this industry. Then in the late 1970s, South Korea government began to give priority to skill and R&D intensive sectors, and during this period that the South Korean electronics and automobile emergent industries began to emerge. In the East Asian model of development, therefore, government policy drives industrialization from low-skilled, labor-intensive production to capital-intensive forms of production, and from there to industries that rely on high-skilled labor and tech-intensive production. Each stage is associated with particular types of government policies, and as each stage reaches the limits of rapid growth, emphasis shifts to the next stage in the sequence. Moreover, at each stage, governments stress the need to develop international competitiveness industries. East Asian governments relied heavily on industrial policies. They used industrial policy to achieve four policy goals: reduce the cost of investment funds in targeted industries, create incentives to export, protect infant industries, and promote the acquisition and application of skills. Taiwan and South Korea created incentives to invest in industry that state officials identified as critical to development. To do so, governments in both countries provided firms investing in these industries with preferential access to low-cost credit. In South Korea, the government nationalized the banks in the early 60s, and in the ensuing years fully controlled investment capital. Control of the banks allowed the government to provide targeted sectors with access to long-term investment capital at below market rates of interest. Although the banking sector was not nationalized in Taiwan, the government did influence bank lending decisions. During the 1960s, banks were provided with government-formulated lists of industries that were to receive preferential access to bank loans. During the 1970s, the banks themselves were required to select 5 or 6 industries to target in the coming year. As a result, about 75% of investment capital was channeled to the government's targeted industries. Asian governments also implemented policies that encouraged exports. One method linking access to investment funds at low interest rates to export performance. In Taiwan, for example, firms that export paid interest rates only 6 to 12%, whereas other borrowers paid 20 to 22%. In South Korea, short-term loans were extended without limit to firms with confirmed export orders. Credit was also made available to export or import suppliers and to those suppliers. In addition, deliberately undervalued exchange rates improved the competitiveness of exports in international markets. Finally, a variety of measures ensued that domestic firms could purchase their intermediate imports at world prices. These measures often entailed the creation of free trade zones and export processing zones, areas of the country into which intermediate goods could be imported duty-free as long as the finished goods were exported. Export processing zones allowed domestic producers to avoid paying tariff duties that would raise the final cost of the goods they produced. So hopefully you're getting it. It's giving you all these examples of what they did, but quite simply, you could say, again, the neoliberalism approach, you're like, yeah, the market, but what this approach is saying is like the governments are to blame because look at how they made things possible with policy, trade zones, even the banks, and making it where during each stage when they wanted to promote an industry, they were pretty much giving them better or free money, more or less. I guess nowadays when we get in the modern era, then the money gets free. They say 6 to 12%. But continuing, the Taiwanese and South Korean governments also protected infant industry at each stage. In some instances, measures they used were straightforward forms of protection. The South Korean government, for example, enacted legislation in 1983 that prohibited the input of most microcomputers, some mini computers, and selected models of disk drives in order to protect domestic producers in the computer industry. POSCO initially produced steel behind high import barriers. In other instances, protection was less transparent. Hyundai Heavy Industry, for instance, was protected in part through a government policy that required Korean oil imports to be carried in ships operated by a merchant marine that Hyundai Heavy Industry had itself created. Taiwan adopted similar policies. Finally, the Taiwanese and South Korean governments put in place policies that raised skill levels. Investments in education were made to improve labor skills. In Taiwan, enrollment in secondary schools had reached 75% of the eligible age group by 1980. Enrollment increases were accompanied by rising expenditures on education. Per pupil expenditures increased 8-fold in primary schools, 3-fold in secondary, and 2-fold at the university level between early 60s and 80s. Similar patterns were evident in South Korea, where enrollment in secondary schools increased from 35% in 1965 to 88% in 1987, and real expenditures per pupil at the primary level rose by 355%. Governments also invested in scientific infrastructure to facilitate the application of skills and R&D activities. In Taiwan, the Industrial Technology Research Institute was formed in 1973. A nonprofit organization were created during the 1970s to perform research and disseminate the results to firms in the private sector. A science-based industrial park designed to realize agglomeration effects were created in 1980. In South Korea, tax incentives were used to induce chaebols, the large South Korean firms, to create laboratories for R&D purposes. An industrial state for computer and semiconductor production was created, and the Electronics and Telecom Research Institute, a government-funded institute oriented towards product development, was established there. These policies raised skill levels and created infrastructure that allowed more highly skilled labor force to work to its full potential. This skill upgrading was critical to the transition of the third stage of the industrialization process. So one, it's highlighting here again the point of how the government had an influence in this thing that some people say, no, it just worked out well for the market. Once again, it's showing you how South Korea, Taiwan, and some of these East Asian countries, they were heavily investing in the government to create these tech industries. And if you really want to compare it, think about what we learned about some of those Latin American countries and the ones who did the ISI. What was some of their problem? Remember, the investment for some of this stuff like telecom and getting some of the infrastructure, people didn't want to do that. In this case, East Asia, they built some very extensive and they funded it very heavily so that they could have all of that and more, and to realize those gains. Again, you could even see what they were talking about with how they were having students and a base of and taking full advantage of a labor force that was highly educated and highly skilled, rather than on smaller industries or having the industries and then not having the labor, or again, what's that thing, the economies of experience that it was talking about. So Continuing, the two explanations discussed thus present different arguments for East Asia's success. One suggests that East Asia succeeded because governments allowed markets to work. The other suggests that East Asia succeeded because governments used industrial policy to promote economic outcomes that the market could not produce. Which argument is correct? Although we lack definitive answers, we may conclude that both explanations have value. By getting prices right, the export orientation and the stable macroeconomic environment encouraged investments in industries in which East Asian countries had or could develop comparative advantage. By targeting sectors where comparative advantage could be created, by reducing the cost of firms and operating in those sectors, by encouraging firms to export, and by upgrading skills, industrial policy encouraged investments in areas that could yield high returns. As Stephen Haggart says, summarized, macroeconomic and trade policies established a permissive framework for the realization of comparative advantage, and more targeted policies pushed firms to exploit it. Although the relative importance of the state and the market in the account for East Asia's success remains in dispute, what is clear is that the experience of the East Asian NICs was vastly different from the experience of Latin America and Sub-Saharan Africa. East Asian governments adopted development strategies that emphasize exports rather than the domestic markets, and they realized substantial improvements in per capita income. The development strategies adopted by governments in other developing countries emphasized the domestic market over exports and generated economic imbalance and modest improvements in per capita incomes. Consequently, when economic crises forced governments to adopt reforms, the East Asian example provided a powerful guide for the kinds of resources or reforms that could be implemented. So, this is scraping the iceberg as far as East Asia is concerned. So we didn't get into any of the crazy stuff, but this should establish now your foundation. So when you see how crisis strike them and what they did, and like it's saying, even the model that they did to even reform, they are even one of those leaders. It's going to be interesting here. So hopefully you've been learning something. If you have any questions, let me know. But Chad, thanks for watching us, ladies and gentlemen. Make sure Hydra Healthy ready to go. Make sure post our watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember what you do every day. That's what you are. Oh, yeah, don't forget, baby. So build some good habits. But Chad, I love you. Drink that water. Stay hydrated, healthy, all that good stuff. I'll see you in the AM and horn.